Welcome to the Commercial Property Podcast. My name is Suzi Carter. I am a chartered surveyor. I've been involved in commercial property in the UK for 30 years and I've done hundreds of commercial property deals. I'm here to be your guide through the commercial property market, whether you're an experienced investor or whether you're literally thinking about dipping your toe in the world of commercial real estate. I will be here talking to you about all kinds of things commercial real estate in the UK, and I've also got some fantastic guest experts who are joining me. So please do subscribe if you'd like to follow, and if you'd like any more help or information on commercial real estate, please do click www.suzicarter.com, which is my website, and you can find out all the ways I can help you. So stay tuned for this week's episode. Welcome back to the Commercial Property Podcast, and today I'm going to be talking about sale and leasebacks. And it's not a strategy that a lot of SME investors use, but it's actually one that is really useful to have up your sleeve. And I would definitely look out for these opportunities because they are openly available. During COVID in particular, there was a lot of these available, but you still see them on portals. You can still get these kind of opportunities through business selling agents and also through just through the commercial portals. But if you don't do sale and leasebacks properly from either side, either from the seller or from the buyer's side, then they can become a real problem. So I'm going to talk to you about what a sale and leaseback is, how and when you can use it, and some of the things to look out for from both sides to make sure that this is a transaction that nobody looks back on and regrets in the future. So at its simplest level, what a sale and leaseback is basically when a business owns the freehold of their, I suppose it could be a long leasehold, but it's more usually a freehold of their operational unit. So they operate from a property, and obviously they could have a portfolio of properties, but they operate from a particular property and they sell the property and take a lease back on it. So they still stay in that building, they still operate from it, but they sell it and they take a lease back from it. So why would a business do that? Well, the obvious answer is to recapitalize without any relocation disruption. And on paper, to just have business as usual without having a costly and disruptive transition to a different building. So it can be hugely beneficial for a business to do this if they want to recapitalize. And this is the reason we saw a lot of this stuff happening in COVID, because there was a lot of businesses that obviously had to shut up shop, had short-term cash flow issues because of the pandemic. And this was a great route for them to recapitalize their businesses. And you saw even people like Next PLC selling their head office and taking a lease back. So plenty of businesses do this strategy, and plenty of investors are really, really happy to do so. So if you think about it from a business's point of view, you don't have the disruption of moving, but you stay put in your existing premises, but you get an input of cash into the business. You also can get a control over what type of lease you're going to put in place to some degree. Obviously, we'll come back to that in a minute. And so, it can be of real benefit if done properly from an operational business. From an investor's point of view, think about it like you basically have a guaranteed tenant in a building. So you are buying a property that perhaps hasn't been openly available on the market, or you wouldn't be able to get hold of otherwise, has perhaps been in owner-occupied ownership for quite a number of years, and you're managing to get hold of a building that you wouldn't be able to otherwise, and you also get a tenant in place who's going to give you a lease. So you have no letting risk, no void risk. You manage to be able to get that tenant to have some continuity. And you know that they trade well from that location because they've been there for a while and they've traded well from that location for a while. And therefore, it's tried and tested. And from an investor's point of view, that can be really attractive. You get a known tenant, a lease agreed up front, and a property producing income from day one. So obviously, that can be hugely beneficial. And so if done right, a sale and leaseback can be a massive win-win for both parties. The investor gets a great investment and the business who's selling managed to get continuity of business while getting a cash injection.
This episode is brought to you by Bond Finance Limited, your trusted partner for commercial property mortgage solutions. Are you an experienced residential property investor about to diversify into commercial property, looking for funding options? Bond Finance can help. Whether you're planning to expand, refinance, or make a major property investment, Bond Finance provides expert advice with access to a wide range of lenders, from high street to specialist. Book a free discovery session today to explore how we can tailor commercial funding solutions to your unique investment strategy. Visit www.bondfinanceltd.co.uk and take the next step in your commercial finance journey.
And I think that sale and leasebacks can work really well if it's used strategically by a business, not emotionally. I think if a business is in some form of distress and they then have to sign a long lease, potentially they are losing control over their own destiny, and they are probably using the cash in a non-strategic way, which might just be, it might be a sinking ship anyway. And so to actually use their kind of main source of, capital potentially to prop up a failing business can be an issue. And it works really well when the business is profitable and stable and just using the cash to potentially grow the business, or de-risk the business, perhaps paying off expensive debt or whatever. The lease terms are sustainable, not aggressive, and I'll come back to that in a minute. The rent represents true market value and not a special deal that's done between an investor and a landlord. So what can happen sometimes is that because this is a horse deal between two parties, potentially off market, is that there's a correlation between lease length, lease terms, and rent. And so there is a temptation for businesses when they do sale and leasebacks to think, gosh, if I sign a longer lease, perhaps a higher rent at potentially more aggressive lease terms. So, for example, I'll do an annual RPI or CPI linked rent review that compounds annually. Then I will get a much better capital sum. And that's absolutely right. They probably will. That property, that transaction will be valued at a lot higher value, because transactions are judged on the lease terms as much as anything, as much as a tenant, as much as a location, etc. But obviously, if they're basically giving away the crown jewels, if they're signing a lease that just isn't sustainable, isn't affordable, then that can definitely wreak trouble for the business and ultimately for the investor, because as an investor, they would have paid a lot of money for a business. And, if it's not sustainable for a tenant, you can either carry that relationship going and just kind of blindly ignore any problems, or that tenant might actually go into receivership or administration. And obviously that's in nobody's interest. So in that scenario, an investor may well have overpaid for a tenant that kind of isn't there for the full term of the lease. But if done well, and it's done properly, and the both sides weigh up their kind of risk and opportunities, then it can be a very profitable long-term relationship for both parties. And for business owners, it can release trapped capital, it can improve cash flow, it can remove property debt from the balance sheet, or it can be used to pay off expensive debt and allow focus on the core business rather than managing property. Because sometimes, obviously, a lot of businesses, they're not property businesses, they are operational businesses for whatever type of business that is. And for investors, it can deliver long-term profitable, predictable income, reduce void risks, strong covenant strength, and create a bankable low management asset. So, it can be one of the cleanest commercial property strategies out there if done well. So what are the red flags to look out for? Well, I think a distressed sale is definitely a sign, because if there's a distressed sale and the business, desperately needs this money to right itself, and potentially the business has gone too far to be So this is just good money being thrown after bad, the proceeds from a sale, then it can spell disaster for both the business and for the investor. And so one of the most important things as an investor to do is check your tenant covenant. I can't stress that enough, really. And you really must just do all the checks and balances you possibly can on that business, because just because they have a operational business that's worth, an operational property that's worth a lot of property money, rather, doesn't mean that they are a great long-term bet. Because at the end of the day, when you enter into a lease with a partnership, you may not look at it like this, but it's a partnership. You are partnering with a tenant, so they are undertaking to pay the rent and repair the property. You are therefore undertaking that you're going to allow them in the property to operate their business. And if one side of that partnership is at odds with the other, then that can wreak disaster. So, if a business is potentially in distress and they're throwing good money after bad by raising this capital from a sale, or if they've got an overinflated rent or a lease length that's too long to justify a higher sale price, there really is a red flag there. A long lease with no break options can be a real problem for a business. There's no flexibility there. Businesses change, businesses flex and grow, and they either want to downsize or upsize sometimes. And, if a lease has got no break options, no option to leave, then they have to try and assign their lease or sublet it. And that can be a problem, because it still keeps that tenant on the hook. So definitely not to be kind of entered into lightly. And aggressive rent reviews with no flexibility, certainly compounded increases at, index linked type rent reviews can very rapidly increase the rental liability. And I've done a few of these deals in the corporate world, and where a corporate has taken a 35-year lease, and when I've been acting for the corporate, we've been very, very forensic with our cash flow planning in terms of looking at where the rent might end up and seeing whether that's actually going to be achievable, especially if you haven't got any other rent, haven't got any other rent coming in, like you haven't got any subtenants or multi-let space or whatever. And so from the tenant's point of view, these things can ramp up pretty quickly. So I've seen business owners celebrate a big cash release and then find 5 years later they're stuck in a long-term lease that they can't afford on a building they no longer own. They've got no flexibility. So, and from an investor's point of view, you can think that you've got a great yield, you've got a lovely long-term lease, you can sit back and just put your feet up. And obviously, when done well, a sale and leaseback can absolutely achieve that. But if you don't do your checks and balances on the tenant, you make them sign a lease that's too long because, you want to get that certainty, then, you might actually inherit a tenant that was already struggling. And therefore, there's a potential problem brewing there because perhaps, you have a 20-year lease in place, but if the tenant goes pop in 3 years, that 20-year lease means nothing, actually, and you've actually overpaid for the property. So this is not the time for short-term thinking. This is the time for longer-term thinking. This is the time for strategic planning from both sides to make sure it's a win-win. And it's really in the interest of both parties to have those kind of upfront conversations. This is, very often negotiations are a bit of a dance where you're trying to get the upper hand. But actually, this truly is a partnership. And so, from an investor's point of view, you need to be sure that the tenant is committed to the long-term future of this property, and the tenant needs to make sure that they're not overpaying as well. So in sale and leaseback, you're almost more buying a lease than you are buying the property. You're buying the tenant and the lease almost more than the property. So the building matters, the location matters. And obviously, ultimately, you need to be sure that even if you do put a sale and leaseback in place, once that lease ends, then are you going to be able to re-let that? Is it suitable for modern requirements? Do you have an asset management plan? And so all the principles I talk about with my clients in terms of having multiple exits on every building, making sure that you've modeled all your exits, it's really, really important, even on a sale and leaseback where you've got a guaranteed tenant. So you need to make sure that, that you do that kind of thinking up front. So Sale and leasebacks can be super powerful when they're done properly, but it's really down to the reality of the situation, reality of the lease that matters. And, it definitely, the quality of the lease and the quality of tenant will influence the price that an investor's willing to pay. So if a tenant, for example, says, okay, I'm selling the property, I'll happy to give you a 10-year lease, but I want a rolling annual break clause. Really, you've only got an annual lease there from an investor's point of view. So then you need to think about, okay, so am I happy with that? Perhaps that's something you want, because actually perhaps you can get your hands on a building that wouldn't be otherwise available to you. And perhaps there are some amazing asset management angles. For example, if it's quite a big industrial unit and you can divide it up into smaller units, and you can actually almost double the rents on the smaller units from the big one, then that could potentially be a great strategy. Because yes, you might be overpaying a little bit, but for the fact that you're getting this off market, or you're getting it as a kind of exclusive relationship, but you're happy to have some income coming in to tide you over, but you've got a very firm plan for that building, that might actually be a win-win. But if you're overpaying, if you're paying for the benefit of a tenant for a very long lease term, then you need to be aware that there is risk around that. And of course, the devil of the detail is in the lease. It's down to the length of the lease, and in terms of kind of what the business wants. Never try and strong arm a tenant into taking a longer lease and saying you'll pay a higher price for it, because that potentially spells disaster. And if you've got a business that you think doesn't take the trends in the economy right now, it's a bit of a dinosaur business, and potentially could be overtaken by competitors or overtaken by a changing market, then there is potentially an issue with that, where you need to understand that that business may actually, just by virtue of the market, not be around for much longer. So the lease is important. Lease length, rent review structure, break clauses, whether there's a landlord, whether there's a tenants, or whether there's mutual or lack of them. Repair obligations, full repairing insuring terms, internal repairing terms, assignment, subletting right, flexibility for the business. So sale and leaseback is actually, it can be a great strategy. It can be really interesting to do direct to vendor letters for this kind of stuff, especially if there's a type of property that you're really keen on, that you're acquiring anyway. So some direct to vendor campaigns to owner occupiers could be a really interesting strategy, and you might just hit them at a sweet spot when they're looking to dispose. But it can be dangerous when this is used emotionally for businesses that are really struggling, where they're being forced into situations that perhaps they shouldn't be. So for business owners, it's about control and flexibility, not just cash. And for investors, it's about understanding the risk, not just chasing the yield. And for both sides, sale and leasebacks only really work when you're planning for the long term. So it's a long-term relationship, or a marriage, if you like. You're basically entering into a JV or a partnership with that tenant for the longer term. So fantastic strategy to use, definitely one to seek out, but one to use with some caveats, because if done well, it can be a really great investment strategy. If not done so well, it can potentially be a bit disastrous. So hopefully that's useful and gives you a bit more insight into sale and leasebacks. And I look forward to seeing you next time on the Commercial Property Podcast.